globally, the economic data has been ridiculously bad, right? I mean, Germany recently, the UK with inflation, Japan with inflation. We know China's struggling, their economy is struggling. And so, what's kind of intriguing to me is that the dollar's not getting a bigger bid,
Yeah.
considering that the economic data here has been really actually pretty good comparatively. So it's almost like, okay, so if that's not giving the dollar a bid, does that potentially mean that when the US economy starts to weaken, which, whether it's in 3 months, 6 months, a year, at some point it will, does that then mean do we have a bigger rollover? And again, it is kind of interesting with the chatter about de-dollarization. Janet Yellen recently saying that people should actually diversify away from US dollars a little bit because it probably won't be the only currency out there.
During a congressional hearing in June, Treasury Secretary Janet Yellen expressed her perspective on the concept of de-dollarization. She asserted that no currency presently exists that could supplant the US dollar, despite the pushback from China, Russia, and other prominent nations due to US sanctions and foreign policy maneuvers. Yellen remains resolute in her belief that devising an alternative to the dollar will be a challenging task for any country. Nonetheless, Yellen cautioned that the global share of the US dollar and reserves may continue to diminish as countries seek to diversify. In June, Germany's manufacturing sector experienced its most rapid contraction in over 3 years, as indicated by a survey revealing a decline in both output and new orders. The Purchasing Managers' Index, PMI, for manufacturing has been below the growth threshold of 50 since July 2022, suggesting a recession in the sector that had previously shown expansion according to GDP statistics in the first quarter. In the provided video, Gareth Soloway discusses the mounting concerns in the stock market and housing market, referring to it as a climbing wall of worry. He also touches on the Federal Reserve's handling of inflation and the dominance of Bitcoin amid the ongoing developments.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Economic data globally has been really, really weak. You'd assume the dollar would be ripping right now.
Right. It hasn't so far.
Yeah, although I will say this, is that we know the US dollar does well when there's panic, right? When there's panic. And if you look at the VIX, and in fact, I'll pop up the VIX here, it's anything but panic. And I mean, you have riots in France right now. You have, there's lots of stuff that you could argue, hey, this should be causing some sort of move in the volatility index and fear. And it's just not. And I was curious about your thoughts on that. I mean, why when we have the potential for, higher rates from the Fed said maybe 2 more rate hikes this year, markets didn't flinch. We see riots in France, granted, that's probably not, you had that potential coup in Russia, markets didn't flinch, granted it was pretty much over, but why is that? And one of the charts I want to show here is mortgage originations by age. And again, the age is almost irrelevant to me. I'm just more focusing on massive amount of mortgages taken here, which was good because interest rates were really, really low. But one of the things, and this is always the rebuttal I get, well, if people got these loans at 3%, they're not walking away from them. But at the same time, I think people aren't taking into account the fact that inflation has skyrocketed, right? So you have to look at what these people now are paying for food, energy, all these other things, in addition to their home price or their mortgage payment. You also talk about if the labor market starts to crack. I mean, how much of this comes back to roost? And do we see a wave of people saying, yeah, well, I took a mortgage at 3%, but if you can't pay your 3% mortgage anyways, what ends up happening? There's this common kind of thought process with investors where it's like the cheaper it is, the better value it must be. And I do think people need to recognize that that's not always the case. You can play them for bounces, but valuation will have to figure itself out as we get regulation in here. And to be honest, it's very hard to figure out what the valuation of a Matic or a Cardano would be. If I flip just to the Cardano chart, I'll show you guys here. Bear with me as I bring that up. So basically, Cardano still hasn't broken out. Matic's starting to peak above the level here, but you can see that, again, Cardano is still up into this resistance, which is right around 30 cents. If it gets through 30 cents, you should head to about 33 cents. That longer term down sloping trend line. So yeah, it's kind of interesting to view. And again, I'm a much shorter term trader. So just kind of taking advantage of these little moves and so forth. To be honest, I think Bitcoin dominance is still going higher. I know you're in the same thought process of that. And I think what investors need to recognize is that last week we got the SEC to say that the Bitcoin ETF filings for the spot were inadequate. And so just naturally, that's going to make Bitcoin investors a little bit more hesitant. And then I also think you have a lot of speculation. I mean, just going back to the stock market and tying the stock market in right now, the stock market has been so strong, like every day floating up, floating up, floating up, that eventually what people do is when everything, like you're looking at some of these stocks that have just gone parabolic, they start to look for what hasn't run. And so I think there's just this natural thing of saying, oh, well, these altcoins are so low, I'm just going to give it a shot, which just creates that little bit of a bounce. So you have the negative of Bitcoin with the SEC, even though it wasn't that big of a deal, saying that the ETFs were inadequate. And then you have this kind of risk on kind of thought process where you're then pushing the alts up a little bit. So at least for me, that's kind of where I am at.
According to one measure, the U.S. stock market has entered negative territory since the beginning of the year. The S&P 500 equal weight index, which assigns equal value to each stock, has fallen by 0.35% since January, as per data from Refinitiv. This stands in stark contrast to the benchmark S&P 500, which has seen a 9.5% gain. The divergence between the two measures of stock market performance is particularly pronounced this time, with no previous instances of such a strong negative deviation, stated Manfred Hubner, managing director at research house Centix. The significant difference can be attributed to the rapidly increasing demand for the largest stocks, such as Nvidia, Microsoft, Alphabet, Apple, Amazon, and Meta. These tech giants have collectively added $3.1 trillion in market capitalization in 2023, according to data from AJ Bell. Excluding their contribution, the S&P 500 has lost $286 billion so far this year. Returning to the video, Gareth discusses the price movement of Bitcoin, the housing market, and the divergence within the S&P 500.
It's pretty remarkable, the crypto sentiment right now, specifically in regards to Bitcoin. Seems like anyone that was on the alt train has now moved into the Bitcoin train, and it's pretty wild out there right now in terms of bullish sentiment. And I would say, so I see a question here about, I talked previously, over the last year, that Bitcoin could potentially decline by as much as 85%. That data point came from past cycles about how much it dropped in each of the past cycles. It was somewhere around that. I actually think that it also has to do with how much of a decline we saw in Amazon. If this was the .com bubble bursting in crypto, it was also looking at Amazon as being kind of the child of the .com bubble, and Bitcoin obviously being the one for crypto. And so if you look back at Amazon back in 01, it bottomed out down about 85+% when all was said and done. So I have a chart here of excess household savings, and we can see that you had this massive increase in savings in the COVID right in that beginning portion of COVID, and still it's coming down, but it's still working its way through, right? It hasn't, because people had so much savings, they're able to withstand and still continue to kind of buy things. But the other question then becomes is, as inflation, continues to take its toll, does that then weaken the consumer even more? But yeah, interesting chart there showing the surge in savings and then kind of the fade on it as it's coming back in here. Just based on purely the S&P chart, what we have here is you can see this upsloping trend line that actually goes all the way back to the COVID low. So if you take that low and you run it right through here to these highs, and it matches basically perfectly with these highs, we actually kissed that high right here before the latest pullback in the S&P, which was about a one week long pullback. And then what we're seeing here is we're rising again towards that same trend line. So I would expect that trend line, if we hit it, let's say later this week, it's not that much higher. I think it's about 20 to 30 points higher on the S&P 500. That'll be your next big resistance level. But again, for me, it's kind of looking at this, and I don't know if you have a chart on this, and maybe I should have given you a heads up, but I was wondering if you had the S&P 500 minus the top 7, the Googles, the Apples, the Microsofts, the Nvidias, and it would be fascinating to look at this year. What's the actual return on the S&P if you take out 7 stocks? And I could be wrong on this, but I think the return is probably in the range of 3%. What I'm showing here, guys, is this is the tech stock sentiment. And so the last time we were this high on tech stocks was in the .com bubble. And so you basically, now there you were higher. It did go higher than that quite a bit when the .com bubble hit. But just interesting to see that we have not been that high going all the way back to the .coms. And the one thing I would just say in regards to these big cap tech is that they have become so mammoth in terms of their market cap relative to the rest of the market that now you have the NASDAQ 100, and basically 50% of the NASDAQ is these stocks. The S&P is about 25+%. And so the reason why that's a concern, because when things are good, it's great, right? It takes the whole market up with it. If you're in an index fund, you're doing great. The problem is that if these things correct, and if you look at historical PE ratios, and this is something that a lot of people don't kind of realize because they're newer investors, but when I was growing up in the 2000s to 2010s and I'm just getting into trading, in a recession, the general PE ratio for a large cap tech was 8 to 10. Well, you have Microsoft over 30, Apple at 30. Like, I mean, there's a lot of froth there because these stocks have been utilized as kind of a safe haven, and they've become so dominant that, again, there's a huge risk there. If all of a sudden those stocks come in, the market could go down 20% in a flash.
The Core Personal Consumption Expenditures Price Index for May, released last Friday, shows that core inflation continues to exceed the Federal Reserve's long-term target of 2%. It stood at 4.6%, while the Core Consumer Price Index released for the same month was even higher at 5.3%. The Federal Reserve relies on core PCE data as its primary inflation gauge. Clearly communicating the 2% inflation goal helps anchor longer-term inflation expectations, promote price stability, and maintain moderate long-term interest rates, enhancing the committee's ability to support maximum employment amid economic disturbances. The Federal Reserve emphasizes the importance of analyzing longer-term inflation patterns and considering their persistence. The focus is on core inflation, which excludes food and energy components. This approach provides a more reliable indicator of underlying price trends. By emphasizing core inflation, the Federal Reserve aims to assess inflationary pressures more accurately and make informed monetary policy decisions. We value your opinions on this topic. Please share your thoughts in the comments section below, as your insights contribute to the ongoing discussion about inflation and its implications for the economy. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.